Hi there, Ruxarmeen here from HBCS, and I am going to present you International Accounting Standard 16, which is related to property, plant, and equipment. Ever wondered how companies decide the value of their buildings, machinery, or equipment on the balance sheet? IAS 16 is the standard that controls it all. In this video, you will learn what property, plant, and equipment really mean, how they are recognized, measured, depreciated, and why even small mistakes can change profits and exam answers. If you are an accounting or IFRS student, this is one of the standards you simply can't afford to ignore. So, in this standard, we are going to learn about its objectives, scope, its initial recognition, subsequent recognition, and its derecognition and disclosure, etc. So, what property, plant, and equipment means? Property, plant, and equipment are tangible assets that are held to be used in the production of goods or rendering of services, for example, plant and machinery, or for the administrative purposes, for example, IT equipment, or for rental to others, for example, vehicles. Now, what are tangible assets? Tangible assets are those assets which we can touch, and they are non current assets as well. What are non current assets? Non current assets are expected to be used during more than one accounting periods. Its examples include land, buildings, machinery, plant, vehicles, furniture, and fixtures. Now, there are three key issues which we will face while studying IAS 16, that will be its initial recognition, its measurement, subsequent measurement, and derecognition. So, what is the scope of IAS 16? Like, what IAS 16 covers? IAS 16 covers owner occupied land and buildings, machinery and equipment, office furniture, motor vehicles, assets under construction, and bearer parts as well. Then, what IAS 16 doesn't apply to, like what it excludes? The excluded items are below: investment property, assets held for sale, biological assets, intangible assets, minerals, and PPE measured at fair value under other standards. The type of standards we will apply, that will be IAS 40, IFRS 5, IAS 41, IAS 38, and IFRS 6. Then we are having its recognition criteria. Like, when we are going to recognize property, plant, and equipment, we will recognize property, plant, and equipment only if its benefits are probable, and the second one is the cost can be measured reliably. If either condition fails, expense it immediately. Its examples include, for example, major machine, we will capitalize it; routine repairs, we are gonna expense them; major inspection, we are going to capitalize it. Now, its initial measurement. Property, plant, and equipment is measured at cost at the time of recognition. Following are the costs. What costs are going to be included in property, plant, and equipment? Cost include, like, what type of costs we are going to capitalize: purchase price, less discount and rebates, then import duties, delivery charges, handling cost, assembly or installation cost, site preparation cost, professional fees, testing cost, direct cost, that is direct labor, direct material, and direct expense, production overheads, borrowing cost under IAS 23, and dismantling or decommissioning cost. But note here, in testing cost process, if business earn any income during it, it should be recorded separately as other income or revenue. What costs should be excluded that will be charged to the statement of profit and loss include training cost, insurance, non-production overheads, any abnormal cost, and operating losses. What is meant by dismantling cost? So, dismantling cost relates to, it is the estimated cost to dismantle, remove, and restore the site where an asset is located when the entity has a present obligation to do so. Initially, it will be recognized as provision under IAS 37. The amount capitalized is the present value of the expected dismantling cost. So, its journal entry will be like, for example, future cost is 10,000 and cost of capital is 10%. So we will find present value. That will be 8264.463. Its journal entry on 1st January 2024 will be debit non-current asset and credit provision for dismantling cost. Subsequent measurement includes unwinding of discount. The provision increases over time due to the passage of time. This increase is recognized as a finance cost or interest expense. Its journal entry will be debit finance cost or expense and credit provision for dismantling cost. That is 826.446 is the 10% of this amount. Then closing provision will be 9090.909. All these costs will be excluded, that is administrative cost, etc. Then its subsequent measurement. Subsequently, property, plant and equipment may be measured as cost model or through revaluation model. Subsequent expenditure can be treated as either capital expenditure or revenue expenditure. Capital expenditures are those expenditures which are added to the cost, and revenue expenditures are treated as expense like day-to-day servicings or small parts. Then we have depreciation. Depreciation is the systematic allocation of cost to expense. We are having different models for depreciation. Depreciation includes straight line method, reducing balance, sum of years digital, and activity based as well. Straight line method includes cost less scrap value divided by useful life. Reducing balance method includes first year depreciation will apply at cost, then from second year onward depreciation will apply on carrying value. And we are having production unit method as well. Component accounting, that is very important for exam. If part of an asset have different useful lives, they must be depreciated separately. For example, building, its structure for example is for 40 years, roof is 15 years, elevator is 10 years. Each component will be depreciated individually. Now we are having derecognition. We are going to derecognize property, plant and equipment when it is disposed of or no future economic benefits are expected. Any gains or losses will go to property profit and loss, and surplus on revaluation is transferred into retained earnings, if any. Its presentation: property, plant and equipment presented as non-current assets, shown class-wise like land, building, plant and machinery, furniture. Revaluation surplus shown under equity, that is OCI. Disclosure requirements: an entity must disclose measurement basis used, depreciation methods, useful lives or rates, gross carrying amount and accumulated depreciation, its reconciliation of opening and closing balances, restrictions on title, capital commitments or revaluation details. These all were the overview of I-16, like its objective, scope, recognition, measurement, derecognition and disclosure. Now we will go through the step-by-step framework of IS-16. First, identify whether it is property, plant or equipment or not. Most of the students make mistake while identifying property, plant or equipment. Then check recognition criteria. If it can be measured reliably, its cost can be measured reliably, then only you are having to recognize it. Measure initially at cost, select cost or revaluation model, depreciate this systematically, review estimates annually, account for subsequent costs, test for impairment, derecognize on disposal, present and disclose properly. Now I will show you some common exam focus points or mistakes. Capitalized training and admin cost. We cannot capitalize training or admin cost. They should be expense out. Depreciating land. Land can never be depreciated. Ignoring component depreciation, mixing cost and revaluation models, forgetting annual review of useful lives, revaluing only one asset in a class. No, we have to revalue whole class of asset. Treating repairs as capital expenditure. No, they can't be treated as capital expenditure. Now, quick recap, last minute revision will be like IAS 16 deals with tangible long term assets like tangible non current assets. Recognition requires future benefits plus reliable cost. Its initial measurement will always be at cost. Now we are having two model, that is cost model or evaluation model for subsequent measurement. Depreciation reflects pattern of benefits. Land is not depreciated. Component accounting is mandatory. Disposal or gains will go to profit and loss. That's all. Thank you.